Okay, I'm getting the cue to go ahead and start with today's webinar. Now we'll just share the screen here, make sure everybody can see everything okay and there's no further technical issues. Now, just a little bit about myself. First of all, I want to thank everybody for attending here this morning. My name is Greg Firman. I've worked in the futures and Forex markets for the last 12 years and in 2006 founded eTradeFX, which is an introducing broker firm and advisory service. I am Series 3 Commodity Futures and Series 34 Retail Forex licensed and registered with the Commodity Futures Trading Commission and the National Futures Association as a commodity trade advisor and introducing broker. I've worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading while also providing very specific risk management models with preservation of capital the primary focus along with steady growth. I have further worked as a market analyst for TraderPlanet.com since 2008, a prominent free social website that globally connects traders where I provide daily commentary on a large number of followers in the Forex futures and stock markets. Now, in today's webinar, we're going to be looking at a review of the US dollar index, gold, and the S&P 500. We're going to be looking at seasonal and monthly patterns, and we're going to review the major Forex pairs and how to trade them to start 2014. Now, the first thing I want to bring up here is the US dollar index. Now, this is something that I often hear and talk about with other analysts and other traders that they really don't look at or pay attention to. Now, the reason why we should be paying a lot of attention to the US dollar index, whether you're a currency trader, a commodity trader, I don't think it really matters here, guys. The fact of the matter is the dollar is still king, and when the dollar moves, it affects everything across the board. So to start the webinar today, you can see here that I've got a white vertical line and a white horizontal line, and it's sitting right around this area and around our current area where we are right now at 80.96. Now, this line, you'll notice, also has a date to it, which is January the 7th, 1 year ago. So 1 year ago today, the actual US dollar index is exactly where it was 1 year ago today. Now, from here, you can see that I'm on the daily time frame. We can identify the trendline resistance and the trendline support with what I would call basically mildly bullish. And the reason I'm using the term mildly bullish is because we are smack dead in the middle of this range. Now, what I'm going to do in a moment here is I'm also going to illustrate the correlation the DXY has to pairs like the Euro-US, US Swiss franc, Great Britain US. The correlation is actually almost 100%. So if you're a currency trader and you're not taking other markets into consideration when you're trading, then you have a very narrow scope of what you're looking at. Now, some very important facts that we have to look at based around CFTC data, and that's about 75% of the people in the markets do not make money. That is just a fact. Another fact we want to look at is that the markets predominantly are only trending 20% of the year. So the 80% of the year, 75% of the year coincides with the amount of traders that are not making money, in my respectful opinion. So we have to be smarter than most. We have to look at certain things. We have to look at seasonal patterns. And this particular pattern is indisputable. So the fact that the dollar index is smack dead in the middle of the range and we're at almost the exact same price where we were 1 year ago, in order for the dollar to trend, we have to break through this trend line. We have to break through this upper Donchian band. But there has to be a break outside of that, or we are theoretically still range trading. You'll see that what I see even with my own direct clients that I work with on a regular basis, people that come to me, they're heavily focused on Fibonacci, Elliott waves, when in actual fact, the majority of the market is focused on Fibonacci. But again, we have to go back to that CFTC data. That's very important that we realize that there's a problem potentially with that type of analysis. Now, with this, I don't need a lot of indicators. I don't really need to clutter up my screens to any real extent. But the main thing I want to know is that when this dollar index breaks out of this range, something big is going to happen. Then and only then will we go into trending markets. Right now, we're coming out of the Christmas season. We've seen wild price action in Euro, US, pound, dollar. which really led to basically just a lot of retail traders being stopped out. They ran the stops on the long side, then they ran the stops on the short side. For example, pound dollar broke through a critical range. They ran the stops for all the guys that were shorting around 164.50. They ran those stops. Then the same people that were short then turned around, changed their positions, went long. Then the poor guys got stopped out on the long side too. So this is the kind of games that they're playing, right? But when we look at things, we understand things. That's why a lot of your very good analysts will not really make any predictions during the Christmas break. They will focus once real money comes back into the market. So what we can assess from here is that the dollar essentially is still in a very substantial downtrend. Now, how does what the Fed said in his last statement, the dollar became very bullish. But after a week or so, we really had to look at what the Fed his statement was confusing, because what the Fed had stated earlier that they were going to start raising interest rates once unemployment got below 7%. Then they turned around and contradicted themselves and confused the market even more by saying that regardless of what unemployment goes to, they are not raising rates. That's a bold statement, and they did cut back on the QE by $10 billion a month, but they're still doing $70 billion a month. So in the end, nothing has really changed. Not a lot has changed. The dollar is going to have probably a very similar year in 2014 that it had in 2013. And this is the hardest thing for the retail trader to digest, because they want a trending market, but we can't force our will on the market. So we have to look very closely at these things. So right now, to start the webinar for 2014, we're carrying on with where we left off from 2013. In actual fact, nothing has changed here, guys, to start the year. So we have to be very cautious. There's some people getting very, very aggressive with shorts on Euro US, getting very, very aggressive with shorts on pound dollar. We're going to have to look at that, because that may not be the case. Now, from here, what I want to do is I want to go into something that I deal with the hedge funds I work with my own direct clients. We look at the monthly patterns. We've looked at the seasonal pattern here. The seasonal pattern here is the dollar is exactly where it was 1 year ago. And 1 year ago, I will point out that in January, it did not. It actually sold off in January, and the dollar index back in the first part of 2013, it wasn't until February, the middle part of February the 14th, right here. I'm going to outline this so everybody can see this. Right here is when the dollar actually started to rally. It went back and forth, but then the big dollar gains, they started coming up here, again, mid-February. So January is going to be a very tricky month. So as long as we know that, when we go back to that, when we look at our trend line support and resistance, we're looking for a break on either side of that. When we get a break on either side of that, we can buy or sell dollars at will. And we're going to have some very, very good trading. But until then, they're going to try and push it. The market the bulls and the bears are fighting things out. And until the market decides who wins, the bulls or the bears, we are going to continue sideways. Excuse me. Now, when we look at this again, so when we look at the yearly patterns here, the seasonality of it is that we're looking for that break. Now, have we got it yet? No, we haven't got it yet. We're still, when we go back to this daily time frame, you can see that on the daily time frame, we are still stuck. Now, if I go up to the monthly and we look at this, the dollar remains in a very significant downtrend. So from basically where we are now, it has not had an easy ride. The dollar has predominantly been very, very bullish. Going back to 2003, this white line is a simple 100-day moving average. And the simple 100-day moving average has basically contained the dollar index for the last 10 years. So until we get a sustained break of that, a sustained break of the trend line up here at 84, then the dollar is not looking that bullish. Now, we're mildly bullish on the weekly. We're trying to push through that trend line. So again, that's giving a very bullish tone. And that's fine. Now we're looking for the dailies to follow through. It's very, very rare that the weekly time frame trend line breaks before the daily does. Now, and again, we're sitting right on that level right there at 8107. So we're going to be watching this very, very closely in the month of January to see if we can push above that. Now, what we want to look at going into the year, I'm going to bring this up so everybody can see this. We're looking at correlations. In this particular case, I'm using the Vantage Point software as an indicator to show basically the intermarket component of this and what the US dollar is actually correlated to. So when we look at this, we can see that there is still a heavy correlation here. That if equities are going down, the dollar is going up. And again, we're trying to push through that trend line. Now, when we push through a trend line like this, there's a couple of things that I want to point out while we're looking at this, and I'm going to talk about this essentially throughout the webinar, is that we're looking for specific candle formations here. Candles that have absolutely zero lag. Absolutely zero lag. That's what we're important. Now, when we look at this, what we're going to do is we're going to look at certain candles that are going to affect how we make decisions. So essentially, when we look at this type of candle right here, I'm going to bring this up here so everybody can see it. And this type of candle is a very interesting candle, and it's this one here that I'm talking about. You have this incredibly long wick, and then you have a very short stubby body, and there's almost no wick on the opposite side. So when we see candles like that, whether we're on a currency pair, whether we're on a stock, whether we're on a commodity, we would automatically buy or sell the next candle. And this has a very, very high win percentage. Some people call it a Pinocchio, some people call it a pin bar, but it's a very, very important candle when combined with a potential trend line. And it can trump Fibonacci, it can trump Elliott wave, it can trump a moving average cross, it can trump all of that because it's based on price action and nothing more. And when we see something, they don't show up every day, just to point that out. So when we see that, that's something we want to jump on that pretty much right away. And I'm going to show several examples of that throughout here. So right now, what we're noticing with the S&P 500 is there is still a very strong correlation here that basically the dollar down, the equity's up. That correlation is not broken. Now, there are times when we get into December, this is a classic December trade, where we can see the dollar and the equities moving up together. But ultimately, one of the other wins, and you can see that the dollar was the loser of that battle. Now the dollar is recovering and crossing over, and you can see that the equities are having a negative response to that. So when we're looking at the S&P 500, 1810 here, guys, for you equity traders on here, this is a pretty significant trend line drawing here. It's actually quite significant. So if we lose this level, we could finally see these equities come off a bit. Now, when we're looking at gold, we're looking at the correlation of gold. There's a very similar candle there again. You can see the gold breaking through that trend line. You can see the moving average following that predicted moving average, crossing that and pushing above. But then we have a very strange candle here. Again, you can see that this candle has a very long wick. There's almost no body in it. That is an indecision candle. But again, looking at the dollar index, predominantly, and I'm saying predominantly, this is not 100%, but you can see that as gold sells off, that fuels the dollar strength. One goes up, one goes down. Nothing that I've seen in the market to date changes that. So as the dollar starts to rally, you can expect the gold to move lower. That's a common denominator. Now, with oil tends to move on its own. There's not a high correlation between the U.S. dollar and oil. A very mild one, but predominantly oil is its own animal. But here's where we come to the meat of this. When we're looking at the Euro-US pair, how could you not look at the U.S. dollar index? The correlation here is 100%. So essentially, as the euro makes a move to the downside, the dollar index immediately responds. The correlation is again 100%. So if the dollar is strengthening and we're doing proper intermarket analysis on the dollar index, then that will directly tell us what's going to happen to euro, US, pound dollar, and US Swiss franc. It may not help us out that much with Aussie, US, New Zealand, US CAD, but the main pairs that people trade are pound dollar, euro, US Swiss franc. These are some of your main pairs that people trade. Some of my own clients even will only trade euro, US, and pound dollar. They will trade nothing else. So if they're doing that, they now understand that they must look at the US dollar index. They must. the correlation here, every single move on here has led to the opposite move on the other pairs. So as the euro goes up right here, you can see the US dollar index immediately responds to that. There is zero to the debate about this. So when we look at that, there is no Fibonacci. Fibonacci has no meaning here whatsoever. Neither does Elliott wave. Neither does any of these. A lot of the other standard indicators, they can be completely trumped by an aggressive move in the dollar index, and then that will translate into a very aggressive move into certain pairs. The pound dollar, I would not say the pound dollar is 100% correlation, but I would say it's a strong 90. So when we see right here, again, the correlation, one goes down, one goes up. It's immediate. There is very little that can be argued here. There is no, you can see that I have no Fibonacci here. I have no Elliott wave. I don't have complex mathematical formulas. I don't have any of that. So the main thing I'm looking at is price action, and then I'm looking to confirm it with indicators after that. So again, there is a very, but there is, you can see there's a moment right here. That's why I'll say 90%. That was not a clear correlation. As one went down, the other one went up. There is times where it's not 100%. That's why I'll give pound dollar about a 90% correlation. Now, as we're looking at some of the other pairs, US Swiss franc, again, this is a very, very important setup that I'm going to show you. You will see this type of candle. I would primarily focus on this candle in the H4 and the D1. This is a daily chart we're looking at right now. This long wick, this body and the top of this candle has virtually no wick on the top of that candle. In this particular scenario, what we're looking for is we're looking to buy on the very next candle. Now, this is a classic case because this has identifiable support here. The wick broke through that support. Trader goes short. Within a matter of hours, he stopped out. And then, but however, with myself, my clients, the people I work with, we are pre-programmed that when we see this, we immediately buy the next candle. Even though it's predominantly in a pretty significant downtrend, but you can see how the market starts to turn around. And again, there's numerous names for this candle, Pinocchio, pin bar. I've heard all kinds of different names for it, but just understanding what that looks like. And when we see this, we want to react to it. So when we come back and we look at the Euro-US, again, the Euro-US candle, the same thing is predominant right here on this candle. You have that long wick. You have the body is about 20% of the entire, 20 to 30% of the entire move, and the bottom part of that body has no wick attached to it. That is a classic reversal candle. You can see again here, it broke through. There was an identifiable area of resistance. It broke it. It ran it all the way up. They made sure they got all the stops on the short side. And then within a matter of a day or two, it's incredibly bullish. So these are the kind of things you want to watch for. Going into 2014, watch these setups very, very carefully because they are going to be leading indicators as to what the real move is going to be to start the year. And that usually takes place around the second week of between the second week of January and the second week of February. We're going to hopefully see some trending markets, but know your setup. So when you're looking at this, be very, very cautious of these types of setups. You see them all over the place. They don't come around that often. You can see there's another one right here. I'm going to show you this one also. And this is, again, a bearish warning of a bearish reversal. So within the trader goes here, the next candle opens up, you sell on that candle. That led to a massive move to the downside. From the 92 level all the way down to the 88 level, I see traders fighting it out every day. Trading on the 15-minute to 5-minute time frames, try your best to stay away from those time frames because you're never going to get a true price. Look at the bigger picture and then go back. So right now, the primary basis of doing this is we're looking for the correlation. The correlation is 100% on the U.S. Swiss franc. The Aussie-US, not so much. There is a correlation there. I would say the correlation on the Aussie-US currency pair probably more along the line of about 70%, but the Aussie can be its own animal too. And that's evident here. You can see that the dollar moved up. there's been times here over 2013 where the Aussie and the dollar gained strength together, which I also found very, very interesting. When I look at the CAD, there is a very, very high correlation between the dollar index. Even though the CAD makes up a very small part of the US dollar index, it's still very, very valid. So we can see the correlation here when we get a signal. So even if you're using standard moving averages, whatever indicators you're using, if you see a big move in the dollar index, then you definitely want to jump on board for that type of move. It's very, very important. So we can basically go through here and assess what's correlated, what's not correlated. The New Zealand US, this correlation I would put at about 60%. It's very small. But the dollar yen, again, the dollar yen can be a very tricky pair, but we're looking at the key levels. The key levels here, you can see right there, the correlation is still there, but the yen and the dollar, in a lot of times, can go together. And the reason that can be a risk on, risk off trade. I'm sure everybody's heard that. And we want to be careful of that if it's a risk off environment. If it's a risk off environment, the yen can actually overpower the dollar. So you have to be a little bit careful on that, but just for the most part, know your correlations. You can see that this big run up on the Japanese yen, the dollar index was actually struggling a little bit. So the correlation dollar yen, I'm going to put this one about 65-70%. So that's the predominant what we want to look at, understand what's correlated. But the main thing is here, guys, I've talked about it in my past webinars. Go over to Windsor Direct. You don't have to trade live there. I don't trade live there. I've had a demo for years and years because you can get free contracts on the dollar index, the S&P 500, on gold, light sweet crude oil, a number of other futures contracts. This is great stuff, guys. In the U.S., a lot of the guys are paying $200 to $300 a month for these kind of charts. You can get them for free on Windsor and then bring up your indicators. Not a problem whatsoever. So when we look at all of these indicators, the main thing we want to do here is we want to be able to identify the overall range. Now, you can see that I've got some moving average crosses in here. I've got a number of other different indicators, but some of your main ones. A Donchian band is a great indicator because it commits. When we look at Bollinger Bands and some of these things, they're very non-committal. And what I mean by non-committal is they tend to be wide open as the market's going up. They open up very quickly. I would also recommend moving your Donchian band from a 20 period to a 30 to try and weed out some of that market noise. Excuse me. Now, when we look at this, when we look at the euro a little closer here, now again, you can see that I've labeled this for our chart so we can look at this closer, that essentially this pin bar, there's that candle, and again, it's coming off that trend line. The next candle was quite bullish. Everything looked great, but then it immediately collapsed. So from here, again, the trader could come into the daily time frame, look at this at the end of the day, and when this candle closes right here and this candle opens, so if this candle opens right here at 137.55, immediately a short trade is entered, immediately. And you can put the stop can be fairly tight on this, about 80, 90 pips. If 80, 90 pips, is too much for you, then simply lower your position size. And that is, again, something that's very, very important, that we lower that position size. So when we look at the euro, we look at it a little closer here, it's turned bearish. Now, when we look at it in the monthly time frame, again, we've got a very mixed signal. We've got these Pinocchio candles or these pin bars side by side. One saying bullish, the other one saying bearish. So at this time of year, and I can't stress that enough, we go back and look at that dollar index. So to reinforce what I was saying, we come back here to the dollar index. Until this breaks, Euro-US is not going to break. So the dollar index will be the leading indicator for what happens to Euro-US. And this type of analysis, and moving away from single market analysis, covering your charts with all kinds of different moving averages, all kinds of Fibonacci. A lot of people say that there's only one Fibonacci level that matters anyway. So, and that's the one you should focus on, which I think is 61.8. So, all those other ones, they really don't have any meaning to anything. But, that's just in my respectful opinion. I want to keep this as uncluttered, and I know that if something happens right here, that I can immediately respond to that in the currency markets by buying US. If this upper trend line breaks, I can sell Euro US immediately. I can buy US Swiss franc. I can sell pound dollar. There's an immediate reaction to what can happen here. So right now, when we're looking at these things, there's a lot going on that, that would lead us to believe that the dollar is strengthening. But don't forget that range is not broken. So when we look at this in the weekly time frame on the Euro-US pair, there is that candle that I've talked about, and it is a bearish one. So right now we can assess that the DXY, the US dollar index, which we know the Euro-US correlation is 100%. Okay, 100%, not 98, 97, it's 100%. So this is showing us we've got a classic pin bar candle sitting there. We've got the dollar index challenging that trend line resistance. This is pointing towards a bigger move coming to the downside, but we've got to get through 135.30. If we get through 135.30, then this thing's going to run. That's the likely outcome. That move has already started. You can see we've broken the trend line. The center Donchian band. This is something, again, I want to talk about. We have the upper Donchian band, the center Donchian band, and the lower Donchian band. The center Donchian band is an absolutely critical band because it's the halfway point between bullish and bearish. In most cases, when it's above the center Donchian band, it's bullish. When it's below, it's bearish. That's the kind of way you want to look at this. So we've got some problems there, and you can see that I work in additional indicators. I bring in the RSI. I am not interested in the RSI from an overbought or oversold concept. And the reason for that is for the fact that, again, we go back to that CFTC data that 75% of the market participants are not making money. Well, 75% of the market participants are using the RSI or the stochastic as an overbought or an oversold signal. They're using Fibonacci. They're using some of these different things that may or may not be effective. So we're always trying to think outside of the box here. That's something I work very closely with my groups of guys and the fund managers that I work with. Very, very important, because if everybody's doing it, chances are, some people call the bulk of the traders the herd. And if the herd is doing something, the chances are they're going to get into trouble. So we want to try and avoid that scenario. So right now, when we look at the euro, Euro-US, we're waiting for that breakout with the US Swiss franc. Same thing, guys. There is that reversal candle, just so everybody can see it right here. So when we look at this candle right there, it warned us, and it always breaks through a major support or resistance level, gives the market a head fake, and then turns around and whipsaws them all out, and back up it goes. These are the kind of moves you do not want to get caught in. You will not see that if you're trading solely in the 15-minute time frame. You're going to have a problem. Absolutely, you're going to get caught in that whipsaw. So always come out to the longer time frames and then work your way back in. On the daily, we can see it's clear as day that the Donchian band broke. We've got a trend line forming there, and then we have this long candle right here. I'll just bring that up so everyone in the daily is very evident. There's the long wick. The body makes the requirement just barely. We enter long on this candle right here. Next thing you know, within the next 1, 2, 3, 4, 5 days, before you know it, you're up 300 pips. So 300 pips, say you have a 10K account, you're doing a 10K trade, $1 a pip. You just did a 3% return, guys, in a matter of a week and a half. There's fund managers out there that can't do that in an entire year. So if you know what you're looking for, then things are going to be much easier. Now, I did see something flash there for questions. I will have a question and answer period, but I certainly will try and get you guys while I'm in there. Now, one question here FX Wolfie has asked me is, are non-dollar pairs affected by the DXY? Just a little tidbit for you to understand is that these cross pairs are synthetic, which means they don't really exist. Now, let's say, for example, Great Britain, Australia. There is no such thing. For Great Britain, Australia to be traded, it has to go through Aussie US and Great Britain US. You just don't see that other trade. Now, on the CFTC exams, they make us calculate exactly how many of one I have to buy of this one, and then it goes through the dollar index. So it is affected, but the dollar index will affect the main pairs. So you have your euro-based, your pound-based, and your Swiss franc-based. The dollar index will affect those cross pairs. You just don't see it. But there's actually multiple transactions. When you buy Great Britain US, for example, you're actually buying, when you buy Great Britain Australia, you have to buy Great Britain US and you have to sell Aussie US. You just don't see that trade. Now, overseas in New Zealand and Australia, I believe that some of their clients, they do make them do that calculation, so they know how to do it. So, now the yellow line, the other question you asked, the yellow line is an intermediate area. It's a 25-day exponential moving average, which can also be used. And again, that 25 exponential moving average acts as a pivot between the 100. And again, that little setup right there. So if it breaks through the 25-day EMA, the next thing it's going to go after is likely the 100, which you can see it did. But then the market stalled right around that area. It's trying to push through that area. So it'll be very interesting to see how tomorrow's candle opens up on U.S. Swiss franc. It does look bullish, but again, we want to make sure we're coming back to confirm if it's actually bullish. And the dollar index is not confirming that yet, guys. I think we're a few days away from that. So we want to make sure we don't get caught up in that. And the pound dollar, we're gonna again, the pound dollar has an incredibly high correlation. Here we are again, back at this level that I talked about in the beginning of December in one of my initial webinars. And myself, my clients, all we've been doing is selling into that 164, 164.50. We did it for weeks, and it had nothing to do with any kind of complex analysis with all of these different things. There's a resistance line there. That's it. I don't want to complicate things. I want to make it easy. How long does it work for? It works until it doesn't work anymore. That's the best answer. And you keep your stops tight. And eventually I was stopped out. I had to trade 7 days in a row. And finally during the Christmas break, they stopped me out for 50 pips. But I walked out with 200 or 300. So I know I'm going to give something back, and I know that I'm trading counter trend. But it's what, you do it until it doesn't work anymore. So right now, if the pound dollar is really going to show any kind of real strength, then it needs to break through this level. Now, there is a couple of things that I noticed on this pound dollar, which has me a little cautious about shorts here. And there's that pin bar candle. We are on the center Donchian band, okay? So we've never broken through the center Donchian band. We've never broken through that 25-day EMA. So the reason why I'll put in, you can use a 15-day, a 10-day, a 20-day, whatever you guys want. Just put something between that and the 100, or if you're using the 200, particularly a lot of guys still use the 200, and hey, that's a great one too, but there's a big gap, there's a big lag between where the price is. Like the 100-day EMA right now, guys, is 161. That's a long way away from where we are right now. So if I've got some opportunity to sell, then I'm going to do that. But I need this level to break. So once it breaks, then I'll sell. But when I look at this in the D1, that's not pointing to a sell, not just yet. And in the H4 time frame, we're very mixed. We've got a bullish pin bar, and now we've got a bearish pin bar. This thing could go either way, but you can see as we go down into the lower time frames, the signals start to get muddied a bit. Now, H4 is a fantastic time frame, especially if you're using trend lines. Now, we can see that we've got a broken trend line here, and the trend line is not broken. Bring everybody's attention to the left side of the screen. I put this up here, the UTD line, which is the upper trend line, is broken at 164. But when it broke, it immediately slipped back inside. But the fact of the matter is, the lower trend line is not broken. So again, it has a bullish tone to it. But we're waiting for the dollar index to give us that signal. Very, very important. And that's the way you want to look at it. You want to use multiple indicators. So when we're coming into this, we're going to come into the dollar yen here for a minute. And the dollar yen is starting to form some. Now the trend line broke on this at 104.40 on the D1 time frame. But again, as long as you put something in between, you want short-term indicators, you want medium-term, and you want long-term, and you want to kind of layer them in so you get a good understanding of what's in there. Right now, that trend line is broken. Now, on the H4, we're seeing some pretty stiff resistance up here on dollar yen, sitting up around the 104.70 area. We broke through there yesterday, or we tried to, and it immediately retreated back to the downside. But right now, we're holding firm. Now, in this particular case, this actually has a bearish tone to it. So we've got the 100-day EMA sitting at 104.21. We can see the buyers are running, the buyers are buying off that 100-day EMA up over the last 1, 2, 3, 4, 5, the last 20 hours. However, they can't get above the 25, and they can't get above the center Donchian band, and they can't get above the trend line. So if we can get above that, then hey, we've got a pretty good long signal here. But this is the key setup in a chart. 90% of the traders out there, they will not buy high and they will not sell low. There is no reason not to buy high. All we're doing is looking for a break of the trend line, and then we're looking for the next candle to open above 104.66. That'll be a confirmed trend line break in the H4 time frame, and we can fire at will with longs, but the average trader will not do that. He thinks that it's easier to sell a rally instead of buying a rally. Try and move away from that mentality, if at all possible, because that mentality puts you in with the herd and with that group of 75% that are not making money. And again, if our indicators are supporting it, you can see that on the H4 time frame, our RSI is pushing above 50, stochastic above the 50. The 50 level halfway point is just as important on stochastic RSI as it is on the Donchian band, because it's the difference between something that's bullish and something that's potentially bearish. So right now, it still has a bullish tone to it. So I'm looking for potentially a break here, but the dollar yen still has a very high correlation, very, very high correlation to the equity market. So the equities are moving lower. It's very difficult for US Japan to move higher. Now, when we look at again with the dollar yen, we come into our monthly time frame. This is exactly what I talk about, how we have a trend line break, and then our next candle opens above the trend line. We have our moving averages across. They're not giving a signal. We're above the center Donchian band. We're above the 25. We're above the 100. We're above everything. So these are acting. People often say that moving averages are lagging. I wouldn't agree with that. I would say that they're used as pivot, support, and resistance areas. They're sitting there. We know where they are. How could they really be lagging? It depends what your interpretation of lagging is. My interpretation is all I want to know is if I'm above it. The key thing with a lot of your moving averages, if you're above it, it's bullish. If you're below it, it's bearish. And then you're looking for the market to pivot off that particular level. That's what we're looking for. Now, in this case, things are looking pretty good in the monthly for dollar yen. It's looking pretty good in the weekly, too. So it still maintains its bullish formation. We're still, even on the daily, we're still above all these levels. It's just taking a pause. For this thing to really start to accelerate, I'd like to see a break of 105.37. Now, with the New Zealand, this one's pretty easy to look at. This is the one I talked about all of last month in the initial webinars. And here we are, 6-7 weeks later. We're still unable to break through this level, 88.22. So we've been buying off this level, 88.22, and keeping our stops tight. This is just like that pound-dollar trade, selling into 164, 164.52. It's an identifiable area. It doesn't require you to get all complicated with a whole bunch of indicators or a bunch of fundamental analysis that really is nothing more than noise, to be honest. So when we look at this right now, Aussie-US has an incredibly high correlation to gold. So what I'm telling you on here, a little bit of free advice, I'm saying it to my own clients, if we lose the critical level on gold, so we go over to gold, the question is, what's the gold outlook for 2014? We need to stay above this level. 1164. If we lose this area, you can see that we basically have a black hole here. Gold's going much lower. Trust me, Aussie-US will follow if that happens. And that appears to be possible. But again, we have to break through that level. That has not happened yet. Now, when we look at things like for example, the New Zealand, it's not quite as, I wouldn't say the New Zealand is quite as bearish as what the Aussie is. And this is a good example of putting an intermediary moving average of a 10, a 15, 25, whatever you choose. Just put something between your 100 and your 200 and your trend line. And you can see, remember, this is a monthly time frame here, guys. So I often, when I'm doing training with my own direct clients, I ask them, how can you not make money off this? You have 3 months in a row with an identifiable support level, which is 80.91. You are smack dead in the middle of this range. There is a good trade there. There's quite a good long trade, but there's an equally as good short trade off of this trend line. But the primary trend is clearly still up. So we want to be careful with things like that. But the main thing is this 25 is acting as an incredibly strong level of support, bottom line. So when it comes down to this level, I'll buy it and I'll put my stops about 50, 80 pips away, give it a little bit of a buffer. I'm not going to put my stop all the way down at 78. I'm not that excited about it. That's a little much, but the main thing is you can see how it reacts to that. So again, not quite as bearish as what the Aussie is, but making sure I get to all of our currency pairs here, guys. I'm just going to speed this up because I know we want to keep this for 45 minutes. The USCAD. Now, the USCAD, this is again something I've worked on with my own direct clients. We have been buying and selling, but predominantly buying. And the area that we'll start to predominantly look for our long trades was basically back here. Okay, so we have our center Donchian band. We've got a cross of our moving averages. The market's crossed over those moving averages. You can see that we've had multiple retracements. There's a retracement to the 25-day EMA, goes back up, come back, tests it, touches it, goes back up even further, comes back down, touches it, kisses it again, goes up yet again, back down again, back up again. And then you can see a staggering 7 days in a row. Cannot get through any of these, cannot go through any of these. Now I am getting a question from, you can go an extra 5 minutes from Extra Boki. Okay, I'll take that 5 minutes. Thank you. Now, when we look at this, again, we want to identify the levels. And the one thing I really want to stress to you guys, don't worry if you get stopped out. Don't be upset by it. Ignore it. Do not get emotionally attached to this. This is very mechanical. So remember what I said before. I'm not going to tell you guys snake oil here and say, okay, if you use all these indicators and combine this with that, this is the win percentage. This is going to work until it doesn't. So when it comes along here, it hits these levels, there's a buying opportunity. You keep your stop relatively tight. Okay? Now, the key levels of support are down here, 105.19, 104.97, but there's a pretty stiff support level down there. Okay? So we can identify with that, right? And when we look at this, when we bring in our trend lines, and, again, a proper trend line. Now, we could draw trend lines. And I used to, in my early part of my career, I used to do this all the time. I would draw trend lines going back minimum 2 years. Okay? And I would say, okay, I need to know price action from here. I've got to go back and look at these past areas. Excuse me. Now, what I've come to realize over the years, especially over the last 10 years, is that the Forex market, the commodity markets, they are very, very dynamic markets. And being dynamic markets, the most recent price action is very important. And if I draw a trend line back, for example, to 2008, which I could do on my charts, that price was very heavily skewed because of the financial crisis. And things are starting to stabilize now. So unless we get some big financial meltdown again, I'm not that interested in what happened in 2008, because that trend line was, well, I hate to say it, but it was self-induced by the market, by Wall Street, with the bonds and everything. I don't want to get into that, but all I can say is that was not relative. That price was not relative to me, to current price action, and in 2008, they don't really meet eye to eye. So it's not something I want to focus on, not at all. I want to focus on the most recent price action. So always remember, you can get indicators out there. You guys want to shoot me an email, eTradeFX gmail.com. I'm happy to give you an indicator that'll, it's not the greatest one, but it'll draw it for you. But manually drawing your own trend lines is, quite easy. What you're looking for is you're looking for a high point, and you're looking for 2 candles to the left and 2 candles to the right. That confirms the top. So when you're looking for the bottom, the same thing. 2 candles to the left, 2 candles to the right. You draw a trend line on there. So you can see this indicator I use. It's okay. It just saves me having to manually draw it all the time. But I know that if it's accurate, that's relatively accurate, that's good enough. Now, one of the questions coming through is, what are my favorite candles? My favorite candle is the Pinocchio or the pin bar, because I truly believe that it's one of the most powerful candles, because it's not right all the time. Nothing is right all the time. A lot of people search their whole lives for the holy grail where it's 100% accurate. Trust me, it doesn't exist. Okay? Like, if you can focus your trading and get up in that upper 70% accuracy, 80% accurate, which I try and strive to do, then you have a very, very good chance of being successful. And when you're looking at this and seeing and understanding when something is actually trending, understanding what a trend really is, and understanding the amount of time per year that you're actually trending. And statistically, it's very low. It's 20%. So if we're using a lot of indicators that are based around the trend, so they say, then you may only have a 20% chance of being right. So, and I'm not, that is, again, in my respectful opinion, okay, I want to make sure I stress that, but over the many years of experience dealing with clients, looking at trades day in and day out, analyzing trades for fund managers, for my own direct clients, you must look at these things and say to yourself, is something really trending? So right now in this webinar here today, we know going forward to be very careful in the month of January. We know to look very closely and at the intermarket correlation here and move away from single market analysis. Now I'm getting some questions coming in here, and I am running to the end of the webinar, so I'm going to let's see if I can get to some of these questions. So what are my favorite candles? The pin bar is my favorite candle. A doji is okay. I'm not a big, I don't go into a lot of stuff with candles, guys. I'm looking for that reversal candle. And the reason I'm looking for, it says, does the pin bar have to be at the extreme of a trend? In my opinion, it doesn't. It needs to be around, it's very, very helpful if it's around a trend line or a moving average. And it's always good for the market to break through it. And if we can break through it, then, if we break through it and then move back above it, that's the one we're looking for. How do you handle economic data releases? I don't. The economic releases, my advice to give you guys, the majority of them don't matter. The ones that do matter are the non-farm payroll and anything to do with a central banker. And when those are on, I try and be out, because the bottom line is we don't really know. A lot of the market participants don't really know what that data means. So they have to go long, they're going short. Then the Fed says something else, and then they got to relook at it. Then they revise the data. Very, very, very confusing, to say the least. So, very, very confusing. So you don't want to get too caught up in these economic releases, and in most cases, try and just ignore them. Now, I am getting the signal and that goes for news also. That is news. The market is going to react, then it's going to overreact, and in most cases, the price will come right back to where it was. So I'm getting the signal to wrap up, and I know FX Boyke was nice enough to give me that extra 5 minutes, and I appreciate that. So I'm going to put my email up here. You guys have any questions, etradefx@gmail.com. Happy to talk to everybody. I've got to wrap up here. FX Street has been a wonderful host here again, and I hope everybody is coming on to FX Street and utilizing this very, very powerful website. And I certainly appreciate everybody coming out today, and I look forward to everybody at the next webinar. Thank you very much.